Hi everybody, this is Justin Love, your realtor out here in the Okanagan. So today I'm going to talk about another common misconception. This is from the seller's and sometimes the buyer's point of view, but from the seller's point of view, I often hear a lot of confusion with, well, I thought you said the buyers were pre-approved. What do you mean they didn't get financing? So the difference between pre-approval and approval. So a pre-approval, all that's doing, so buyers and even sellers too, everyone can take note. There's something for everyone here. When you go and talk to a mortgage broker or your banker, you're going there to get pre-approved. All they're doing at that point is, because you're just telling them about yourself, what it is you do, how much you make, and they're pulling your credit. And that's the key thing, is them pulling your credit. I mean, that really tells a lot of the story. But anyways, at that point, what they're doing is they're saying, yeah, we would give you some money. We would hypothetically give you some money. Here's roughly how much you could purchase, and here's what your interest rate's going to look like, and we're going to do a rate hold for however many months. The season's always changing, so to be evergreen, it doesn't make sense to talk about how long they're going to hold it for. So they're looking at your credit, they're taking down your financial story, and they're giving you a rate for some amount of time. Now, you could be proactive and bring all your mortgage documents in, and that makes things a whole lot easier when you go to get approved for financing. Quick recap, what are the mortgage documents? So here's what you're going to need eventually when you're doing your mortgage, getting your mortgage approved. Now, the lender may ask for more documents, but these are the basics. So you're going to need 2 years notice of assessments. That's the letter you get back from the government, from the CRA, Canada Revenue Agency, after you've done your taxes. Why do they want that? Because the bank wants to know you don't owe anything to the government, that you're in good standing with your taxes. Next, they're going to want a letter of employment. It's proof that you are gainfully employed. It also writes out what your status is, job status, part-time, full-time, permanent, or contract, and also what you're earning, hourly, salary, and how much overall. So that's why they want the letter of employment. Next, they're going to want proof of down payment. And again, they're going to want to see a few months worth, and again, it varies, but they're going to want to see a few months worth of payment history. The bank wants to see, or the lender wants to see, your savings gradually accrue or build up in your account. If you just show them 1 month, yeah, I got 5% down. Anyone can do that. Anyone can borrow some money real quick or take it off of a credit card and pay it off really quick, and then you don't have down payment. What's the point of that? Or it just shows all of a sudden you got lump sum of huge 5% down. Maybe someone lent it to you, and the bank wants to know whether you're getting a loan for that down payment or whether you actually have it yourself. They don't want it as a loan unless it's a gift from a family member. And that's a whole other can of wax, or a can of worms, so we can deal with that another time. So anyways, proof of down payment. And last is current pay stub. So they're going to want to see that you're still gainfully employed, and that the pay stub more or less backs up what the letter of employment said. So those are the core four. You're going to want, to recap the list, 2 years notice of assessments, your proof of down payment, your proof of down payment, letter of employment, and a current pay stub. So sorry, I keep looking at my list offsite, because otherwise it's a lot to, I always mess that up. But anyways, so that's what you're going to want to see. If you have that up front in your first meeting with your lender, you're laughing. You are so far ahead of the game, because most of the stress when you're getting your financing done, like once you have an accepted offer and you're going through the process of getting your loan 100% financed, it's just mostly people scrambling for those documents. I'm not innocent myself. I've had that problem as well. I haven't been the best client in the past. If you have those documents up front, and I've had people I've worked with, buyers I've worked with, that have heard me say this and actually done it, their stress level goes from a 10 down to a 5. Because at that point, the lender, all they typically really need is just an appraisal on the home, which they order, you pay for, and it's done. So that's what's happening. So in that very, very first meeting, so to kind of recap, I know I kind of went off on a tangent, but in that very, very first meeting, it's just looking at you and, hey, whether we like you or not, we'll give you money. That's all the bank is saying. Once you go out, find homes, make an offer, get an offer accepted, Now you're going back, and the story's different now. Now when you're going to lender, you have a solid commitment that you want to buy something. So now what the lender is doing is they're approving you. So again, looking at your credit and your job history, all that good stuff. So you, the property, and the deal. That's what they're looking at. So the property itself is, where is it? What type of property is it? Is it a mobile home, house, townhouse? They're looking at the property, and they also want to know, and approving the deal part is this good value? And that's why I mentioned the appraisal. They can lenders can sometimes do an automatic appraisal for value, and that's great if there's enough data, or depending on where it's at, it's a sure enough bet. They just rubber stamp that, you're good to go. If it's a bit cookie cutter, or just times are different, or whatever, it's constantly changing with lenders in the seasons all the time. They're going to want a full appraisal. Again, they will order an appraisal done. You pay for it. Again, the cost is always changing. I'm not going to bother to mention cost here because, you watch this video 3 years from now, I can be completely wrong. So that's the difference. So that's why a lender or a realtor will tell a seller once they've received an offer, hey, Mr. and Mrs. Seller, I heard from the other realtor that the buyers are pre-approved. And that's great. And I've also heard, though, when I have to go back and tell a seller, hey, guess what? They didn't get their financing. Buyers have to collapse the deal. Well, you said they were pre-approved. What's going on here? That's what's going on, is they were pre-approved. They weren't approved. You can only get approved for one property at a time. You can't be pre-approved for all scenarios. Things are always changing. Property's always changing. The value's always changing. So, yeah, a lender can't just go, yeah, we'll give you money and go shop and get whatever you want. No. They're going to want to check things out. So again, pre-approval, approval. I hope this answers that question, clears up that common misconception. So again, pre-approval is a rate hold. We like you, we'll give you money. Approval is we are giving you the money on this date. And you want the approval. Once you hear the approval, once you hear you are approved or the buyers were approved, that's a magical time. It's happy time. So, and again, the more you can give your documents up front to the mortgage broker or your lending specialist at your bank, the easier the whole process is and the quicker it goes. So again, any questions, absolutely let me know. If you like this video, please subscribe down below and don't forget to sign up for the alerts. And yeah, don't be afraid to comment down below and ask me any questions. All right, thanks.